Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Well, this is some darned important stuff we're about to cover with you. We're so glad that you chose to spend a little tiny portion of your day with me and Tommy there, talking real money. I'm Don McDonald.
Yes.
That's Tom Cock.
Yeah, you got that right.
And our phone number is 855-935-TALK, 855-935-8255. And we want to help you manage your money better. We really, really, really do, because, well, it's important. And the most important thing you're likely to do with your money is save it for retirement, is build the wealth you need to retire. Because most people at some point, most people want to retire. They just want to.
Do you really want to retire? I don't think I do. I mean, retire?
No, not.
Yeah,
I'll tell you, here's what I would do. I've already thought about this a lot. I would probably do a once a week money podcast or radio show or something.
Mm-hmm.
And I would do a once a week short story podcast, my lit reading thing. And I might do, for fun, a little, because I like acting. I do a little acting once in a while. But that's kind of retiring, because I get to do it when I want to do it.
And you do less of it.
And I do less of it, so I'll have less income. And that's really the key, is maybe we don't want to retire. But when we've been doing the things we're supposed to do for all of our adult lives, or, well, some of us have done most of what we are supposed to do for our adult lives. And it's time to do the things you really want to do before you check out.
Yeah, and here's the problem. I mean, the headlines, you've seen these before. But the National Institute on Retirement Security, they have a study they do about once a year. Mm-hmm. And they look at how good it looks for people to retire, and it doesn't look very good. I don't want to go into all the numbers because it's kind of depressing.
Well, give me some numbers.
Well,
come on, give me the 30,000 foot view.
Half of American workers over the age of 40 have less than $50,000 saved. Now, we can't help you if you're 50. Oh. Well, actually, that's not true. If you're 50 and you've saved $50,000, it's going to be tough.
Stop. That's too depressing. You're right.
All right. I mean, that's one.
We can't talk about this subject anymore. I'm sorry. What do you people think you're doing?
We're going to move on to sports.
How many have?
Half, yeah. Over the age of 40. But, okay, so that's bad. I get it. And the thing is, even if you're 40, you should start doing something.
Yeah.
Or 50. Or even 60. I talk to people sometimes who say, I haven't really done anything. Okay. Do something. Start saving somewhere.
I have to say, to be perfectly honest, I did a few IRAs and the like when I was younger.
Mm-hmm.
But because I was an entrepreneur for so much of my life.
You still are.
Yeah. I've had businesses fail.
Mm-hmm.
Do really well. I've had this whole boom bust thing. And so it wasn't really until I was in my 50s or 60s that I started at least seeing a little light at the end of the retirement tunnel. So I can't criticize.
So you shouldn't. Okay. Well, I think that's a good point, by the way, because a lot of people get to 50 and say, I have nothing, I give up. I think that's not a good idea, but you need to save something. And again, even the people that kind of are saving, it's like 18 million people that don't even save all the way up to the match for retire. I mean, at their employer plan.
Okay, now that's just a bad idea, because that's like
free money.
Looking down at the ground and seeing $20 bills all over the place and thinking, my back hurts too much to pick those up.
Exactly. Which mine does.
But
okay,
you'd still pick up the $20.
Yeah. Oh, you can count on that. I picked up the leaves today. I'll pick up the $20. The thing is, what I find not just depressing about this, but kind of alarming is people have a tendency not to think about this at all until they're about 50. That's one of the things, the findings. They get to about 50, they're like, oh, yeah, I'm going to quit here in a couple of years. Now, a lot of the people that we're lucky enough to talk to that listen to the podcast are like 25 and they're saying, hey, what can I do? That's fantastic. Right? They're saving, they're investing, doing all that. But if you're 50, what do? Okay. First thing is you start saving something, right?
Yep. Much as you
Number
can.
two.
As much as you can.
Absolutely. Number two, you invest it properly. You use low cost index funds. Most of the money should be exposed to stocks, right?
Oh, wait, can I add a number one before the number one?
Yeah, I was just going to get to that actually.
Spend less.
They're spending less, but that gets back to the thing that starts with a P and ends with an N. Because over 50, pain. Good point. Because if you don't have a plan, I think anybody over the age of 50 should have a plan.
Okay, have a plan.
You got to have a plan because if you don't have a plan, where are you headed? You have no idea. You got to have Sam. Here's what I'm trying to do. Most people don't even have that because I'm just saving for retirement. How are you saving it? Well, I've got some I'm throwing in my 401k, et cetera. You really need to know here's how long I'm going to work. Here's how much I'm likely to need. Therefore, how much risk I have to take, et cetera. That has to be at the middle of anything.
So get started, do it right, have a plan, listen to Talking Real Money, and if you're having any problems, you need help, call us at 855-935-TALK. There you go.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Here in Florida, it's downright chilly.
Yeah, to what?
65 degrees.
Oh, my goodness. You're kidding me. That's mid-50s here.
This is the first chilly air I felt in Florida in like 9 months.
It's the temperature. Well, okay.
What's the temperature there?
Oh, it's just 45. Wow,
Ooh,
it's
see, that's 20 degrees colder. Hi, welcome back to Talking Real Money. I'm Don, that's Tom. We're talking with you about your dough and how you deal with it. And now it's time to bring Brian into the fold. He's been waiting
patient
forever. Brian, welcome to Talking Real Money.
Hope we have a good answer.
Hey, so much for having me on the show for a minute.
Oh, we're glad you hung in there.
All
for so
ears.
long. What's up?
Oh man, that's my pleasure. I'm a big fan of you guys, and that's kind of my question today. I'm a fan of you guys, Paul Merriman, and Larry Swedroe. You guys are my four guys that I listen to. I geek out, and I've developed a strategy that I'm confident in. It involves the 10 passive asset class funds that are recommended by you guys and Paul. And I'm very confident in that, but I have like a little misunderstanding, and I wanted to just get your opinion on it.
And it's probably from Larry, isn't it?
No, I'm going to blame Paul on this one.
No, it's got to be Larry. I'm guessing it's Larry. Is it Larry? Come on.
You all know. How did you know?
Because Larry gets into the weeds.
Yeah, Larry
goes a little wacky once in a while.
Yeah.
We love Larry Swedroe.
Yep,
we love him.
Yep.
We love him. We love his accent.
Yeah, we do.
But Larry gets a little weird sometimes because he seems like he wants to justify some crazy, wacky ideas.
So which of Larry's wacky ideas do you want to know about?
Man, you guys are psychic. I love Larry. He's a genius, and I really do actually. I love getting into the weeds. It's fascinating. But the one idea that you asked that I'm like kind of confused about is that he seems to think that if you have 30 years, the only exposure to the market you really need is small in value and some bonds, obviously.
Right.
And it makes a lot of sense if it's an efficient market. I mean, it seems the only risk would be, if you can hang in there, that is, it seems the only risk would be that you would have some tracking error risk.
Oh, no, you see, you don't go any farther. You absolutely nailed it with your first response.
Okay.
If you can hang in there.
By the way, that's an asset class that I think can lose like 60% of its value, or more. Don says here's the thing about that. That's Larry's tails strategy, right? If you look at the bell curve,
that's
stuff
one of his
way
wacky strategies
over on the outside. So yeah, would I expect that makes more if you put it all in U.S. small cap value? Yeah, I would. Would I expect it to be an incredibly volatile up and down ride that would be crazy and have periods of time where you make nothing? I mean, really, literally nothing. I don't manage my money that way, and nor do we for our clients, just for that reason. And again, do I trust U.S. small cap value? Smaller companies that are beaten down to have outsized returns for what I hope will be 25 years of my life. I don't. I'd rather spread it out. I don't know what the next 25, 30 years holds for any. I don't know for stock returns if it'll still be that great for small, and it has been. Mm-hmm. I think we just mentioned this on the podcast, right? U.S. small values made like 13.5% annualized going back to 1927. Way better than being in the S&P 500. But look at the last 12 years, really since the crisis, right? U.S. large has way outperformed U.S. small. And would you have stayed the course, Brian, when you look at all this and say, no, I know U.S. small is going to have by the way, the last year it's up about 70% small value. But would you have been able to hang in there and say, I know it's coming, I know it's coming, I know it's coming? Most people simply cannot do that. They can't take the day-to-day pounding of their portfolio, as you said, tracking error, doing much less than everyone else's. Here's what I think, because I think I got this from Paul. You mentioned Paul Merriman recently, Brian. I think Paul, we talked about this not on the air or anything, but off the air about good enough. I personally think owning a diversified portfolio of thousands of stocks is good enough. You'll make enough over time. Will you make as much as if you had it all in an asset class that has done better? Maybe not, but it's good enough. I'd put it that way.
This is interesting. Okay, 40-year periods. This is actually pretty impressive. The worst, I wanted to find out what the worst 40-year period was for small cap value. It was an 11% return. Average annualized. Pretty darn good. But there have been periods where the decline has been. I don't remember what. I'd have to go back and look at every single chart. But I just wouldn't. Why do it? Why take that kind of crazy risk unless you're just a crazy person? And that's okay to be crazy.
You can already own it. You just don't have to own that much of it. Would be my take.
He's saying that's going to take off some of the edge. But I also think it's like saying, U.S. has outperformed international slightly long term, so why have international? You own international because there are times when that international portfolio makes you feel a lot better about owning stocks. And that's why I think large has a place there. Now, maybe if you wanted to go all value, large value, small value, still risk, but
again, you're making a bet. I mean, I'd rather just own the market and say I'll take what stocks in general will provide, because they provided a lot.
Yeah. Are you done? I didn't know if that was the end of your statement.
I said because they provided a lot.
Period. If he just said period at the end of it.
Great
period.
Amount,
I'm done talking now. I'm doing my research. Who does all the research?
Pardon me. There's
most of the research I do.
You do most of the research. During the show, before the show, I'm the research guy. But during the show, Don's on the computer.
You're trying.
Okay.
Thanks for the call.
I didn't mean to make it look bad,
Brian.
It's easy
we appreciate it. 855-935-TALK. Look at
Brian. Yeah,
now, Tammy and Chris apparently do not have the patience of Brian. That's what I'm going to say from now on. It's instead of the patience of Job, it's going to be the patience of Brian.
Oh.
Yeah, exactly. So.
We lost Chris and we lost Tammy. Okay. Well. And by the way, he makes I think Brian's point is fair. To listen to Paul, to listen to Larry Swedroe and a few others, that's all you don't need to read all the rest of the stuff, because that will give you a basis for very good portfolio development, financial planning advice that will take care of you for a very
855-935-TALK. That's
long
our phone number, 855-935-8255. Call. We'll try to make money make more sense and make it a little easier to manage and do it more sensibly and give you a second opinion about a lot of problems that exist out there. Give us a call.
talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, I've been going through all the numbers for small cap value. Small cap value in 2008, same period where the total market lost about 50, it lost 55.
Yeah. I mean, it's more volatile. It's riskier. I mean, these are smaller firms, right? So when the future looks dim, they should have a tougher time. Value stocks the same way, right? They're riskier assets. And over time, exposing your money to those riskier assets, if you will, has made you more. Not a lot. That's not my ding. That was yours. I guess.
No, that's my ding. I'm dingy.
Oh, okay.
That's just a caller. That's all it's saying. It's saying there's a caller.
Dingy.
Yeah, that's my caller dingy, so I pay attention. And the number is 855-935-TALK. And Cynthia's next. Hi, Cynthia. Welcome to Talking Real Money.
Oh, hi. I'm confused why or if we should have like index fund bonds. You know, they say it's to protect your portfolio, but they lose money. So I don't understand.
Okay, let's take that up for a moment. First of all, the style of bond fund, in other words, should you use an actively managed fund or an index fund? We're always going to say index because it's a lower cost.
No, I think her question is why
I'm
funds as opposed to individual bonds.
Oh, okay. I think she was saying, why are bonds losing money?
No. She said, why a bond fund? Is that what you're saying, Cynthia?
Index,
What?
Index fund bonds. Index fund because I know they're safer.
Yeah, but are you questioning whether you should have a mutual fund or just questioning bonds because they go down?
Well, you got me on mutual funds versus bonds, and I don't know. I just all I know is that bonds lose money when the interest rate goes up, right?
Right.
So, why do we want that?
Do you know when interest rates will rise, and do you know how far and for how long they'll rise?
Right. No.
Yeah.
And by the way, just let's compare losses
saying,
just for a yeah.
You're saying it is good to have bonds.
Yeah, let's talk about the comparative losses. I just looked this up. The intermediate term bond index this year is down about 2.5%. Don just mentioned that when stocks have tough times, they lose sometimes half of their value. Mm-hmm. So bonds from time to time, they'll be down a little bit, but nothing anywhere near what stocks will fall. And bonds have been, U.S. government bonds, a very stable part of the portfolio for a long period of time. So you can't look at everything sort of week to week, month to month, or for that matter, year to year. Bonds hopefully will provide that stability in your portfolio for many years to come. We can't guarantee it. But stocks are far more volatile. And so, yes, we would recommend index bond funds.
See, we all want to only buy the things that go up, Cynthia. That would be a perfect world. We only bought bonds when interest rates were falling. But we can't do that because we don't know. People have been saying for the past 10 plus years that interest rates have nowhere to go but down. But up, and they've actually gone down over the past 10 years. They've gone lower, which means bonds, when everybody said couldn't make the money, actually went up in value.
A lot. Made a lot of money, a couple of years, yeah. So this year they are down, and who knows what next year holds. But again, they're there for portfolio stability. The returns really should come from the stock part. And again, don't get caught up with the fact that they're down a few percent.
Does that help, Cynthia?
Yeah. Would you want to put a bond in your Roth? Because it seems like that would be more, you don't have to worry about taxes in there.
Well, but the bonds don't pay much either. So.
No, I mean, again, the Roth would be where you'd want to have the riskier things like stocks because those have more growth.
Yeah.
And they're
For example,
tax-free.
a bond in your Roth might at best right now, if rates don't change at all, pay you about 1.5% a year, on which you'd pay taxes, but it's only on 1.5%. Whereas
not in a Roth.
But what I'm saying is, if that was
outside,
if
correct,
you had stocks in the Roth and they go up 40%, well, you're not paying taxes on that. So you want to have your more aggressive assets inside your Roth IRA, but you still want to have bonds in the portfolio because we have all got to stop looking at portfolios as all their pieces and parts. They are not their individual molecules. They are one organism. You wouldn't pay any attention to what the molecules in your body are doing, but you pay attention to the whole organism. You need a healthy organism, and that's your entire portfolio. So make sure it has all the right pieces and parts, and then watch what the portfolio does. Thanks for the call, Cynthia. 855-935-TALK.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Wow.
Reality radio for a really great future. We're talking real money.
That telephone number is 855-935-TALK, 855-935-8255. Give us a call, just like Chris. Hi, Chris. Welcome to the show. Chris?
Chris?
You guys all the time. You're awesome.
Thank you.
And recently I read the book by Jack Bogle. It was the 3-Fund Portfolio. And I know that he was an advocate of bonds, but then I noticed today that there are bond replacement strategies. So I just wanted to know if you guys could comment on, are bonds still valid today, or is a bond replacement strategy the way to go?
So what are you replacing them with?
Yeah. What is the replacement?
I know. I just want to hear it from you.
I don't know. That's why I'm asking you guys.
Yeah. Well, let me ask you let me ask you another question, Chris. Which sounds safer to you? Mm-hmm. A security issued by the U.S. government, backed by the full faith in government, that's a security, or a security issued by an insurance company that uses the assets there to invest in all kinds of derivatives, options et al. To make a lot of money and give you part of it. Which sounds like the safer security to you?
I'll go with the Fed.
Yeah, full faith. Yeah.
You know, so that is what you're replacing. And what I mentioned was this bond replacement strategy, because a 60-40 portfolio will never work for the next 20 years because bonds will lose. We have no idea what bonds are going to do starting on Monday. None whatsoever. Has a 60-40 portfolio worked for a very long time? Yes, a very long time. Through great markets, bad markets, rising rates, lowering rates, et cetera, et cetera. So
about
please.
95 years.
Yeah,
Right,
I mean,
at
this is a silly.
years.
This is a promotion, if nothing.
Yeah.
I mean,
And
that's all it is.
Let me just tell you a little bit about these. First off, the Vanguard Total Bond Index ETF has an BND has an annual expense ratio of, ready, 0.035%.
So that's 3.5 basis points.
Yeah.
Yeah.
Basically costs you nothing. The bond replacement strategy being sold by these idiots, that's called an indexed annuity in most cases, or some sort of indexed life product, it comes with an upfront commission to pay to the agent of somewhere between 7 and 10%.
Yeah, we just had somebody come in the office who'd been sold a $300,000 one. Figure out how much that person made in one afternoon who sold them that product.
Mm-hmm. That money has to come out of someone's pocket. Now, I guarantee it's not the insurance company's pocket, nor is it the agent paying him or herself. No, that money comes from you. So if they're promising you a high return and paying their agent 7 to 10%, then you have to have an investment that is of much higher risk. You have to. It's financial physics. That's why I call it physics. It's like physics.
Science.
It's science.
So no, we still favor U.S. government bonds. Thank you. And we still favor using them in a bond fund. Don mentioned a very, very good one, the Vanguard Total Bond Exchange Traded Fund, which holds thousands of securities. Not making much right now, but will keep its value through good times and bad times. That's what you really want from the fixed income portion of your portfolio.
Thanks for the call, Chris. No alternatives. Alternative is just a fancy way of saying we're going to figure out a way to get more money out of you and put it in our pockets. 855-935-TALK is our phone number, 855-935-8255. We have had fights with, there are all kinds of alternatives. As a matter of fact, some of the industry, we talked about this in a podcast, is pushing as an alternative to stocks. They're pushing private equity.
Yeah.
And there are a lot of people pushing it. But we got a note from someone, I may get to that, about Vanguard doing it. These gimmicks are just that. They're gimmicks. They come, they go. There was a time not too long ago when everybody was saying, well, instead of just getting dull, boring bonds, why don't you get some nice auction rate notes? These things are paying a rate that's twice as much or 30% higher, and you can get out of them any day because there's always an auction. There's always been an auction.
Until 2008, and there were no auctions.
Until there were no more auctions, and now you're stuck with this long-term illiquid security you can't get out of.
That's losing its value, of course.
So Wall Street, Insurance Street, what do you call the insurance companies?
Insurance Street. AIG Avenue is what I call them.
AIG Avenue. Yeah, these folks are working day and night to come up with some new, complex, convoluted, expensive, usually riskier than way to separate your money from your person. 855-935-TALK. Give us a call.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to our little gathering of people talking about money. Two guys who are never wrong, and all of you. No, I'm kidding. We're wrong a lot. We've just
been
try
wrong
to be
at
right.
This hour.
No. I think we nailed almost everything.
Okay.
Bonds, we got that right. Yeah, we've been doing okay. 855-935-TALK is our phone number, and Mike is next. Welcome to Talking Real Money, Mike.
Hello, Mike.
Thank you. How are you?
Good. How are you?
I'm good. I'm 78 years old. I've got $9 million in assets and a paid-for house, and I have $3.2 million in IRAs. And every year when I have to take that required distribution and pay the taxes on it, I start thinking, would a Roth be a smart thing to do? Or at age 78, is that maybe a dumb move?
You mean start to recategorizing, converting your money from IRA to Roth?
And if you were to convert it, how would you do it? Would you do it gradually over 2 or 3 years?
Mike, you're already doing it gradually. Yeah. You're already doing it gradually. Your required minimum distributions are about as gradual as it can get.
Yeah, you're taking out about 4.5% at 78, 4.5% of the value, somewhere in that area. Nah, nothing to be done there. I wish there was, but you'd just simply be paying more tax today. The likely. Here's another idea. Okay, wait. I don't know. Are you charitably inclined?
That is an idea.
Am I who?
Charitably inclined. Are you? What's going to happen to this money after you're no longer with us in the
Not
flesh?
That you're dying or old, but what's the purpose?
The day will come.
Right. Indeed.
What are you going to do with this money?
Oh, yeah. Probably go to my kids. I've
got
3 kids.
Because if there was some that was going to go to charity, then there are things you could do to reduce that tax bill. If some of it was going to go to charity,
qualified,
and if you were going to give to charity at the end, this would probably be the place from which to do it.
It makes way more sense. You could do a qualified charitable distribution QCD today, which would reduce your tax bill. You'd give away some of that IRA every year and not have to pay tax on that. That might be the smarter move. But to start converting at age 78, no, that does not make sense. You're just paying tax now that you may never pay. By the way, your heirs may pay it.
And you're very likely going to kick yourself into an even higher tax bracket by doing bigger conversions over the next few years. So I would just continue my RMDs.
And consider the charitable
and
distributions.
And count it was the tax advantage early on that helped you get to a net worth of over $9 million. So you were blessed with that tax advantage for years before. So I'm a big believer in counting those great blessings. You got to eventually pay the piper one way or another. So you can't have a tax-free lunch. Right. There is no tax-free lunch. 855-935-TALK. That's our phone number. And Gates, you're next. Welcome to Talking Real Money.
Tom and Don, how are you doing today?
Good, sir. Good. Thank you.
You both have been very helpful in the past answering questions on Roth conversion, and then Joyce Hankins and Tom spent about an hour on the phone with me at investor.com, so I'm very appreciative of all your help, your entertainment, and your information. My question today, actually two of them, is about the best method of cost basis calculation to elect when reporting capital gains. Two examples. One are some mutual funds that we've owned for years, like 25 years. So they've appreciated a lot in value, have both covered and uncovered shares. So that's one example. The second example is we're going to move our emergency fund into Vanguard's short-term investment grade fund. And we just started that this year, but if that's going to be the fund that we move money in and out of for living expenses, is there a different means of cost basis that we ought to utilize for that one? So two different questions, both on cost basis.
Yeah, and there's two methods of doing the.
Well, there's LIFO, there's FIFO,
yeah.
and then there's average.
Yeah, average. So, because these are purchases you made over time?
The first example are funds we've bought over time, or because the dividends and capital gains were invested, they were purchased over time, some as far back as the late 1990s, and so some have been in there quite a while. In the last 3 years since I've retired, we're taking all the capital gains and dividends for our cash flow because we had to pay taxes on them anyway. But that's one example. So their shares have been in there for a long time and accrued over time. But then the second example is we're going to use the short-term investment grade fund for emergency fund or for our living expense fund.
Yeah, the VFSTX, very familiar with the fund. And I'm going to take that one first because I can answer it pretty easily. The reality is there's going to be not very much interest. I've used that for many, many years, and I don't think I've paid very much tax on any of that. And I've moved money in and out of that fund. I've had it hooked up directly to my bank account. So I don't think that's going to be a big issue. The decision on taking out the other money and paying the capital gains, that is a far larger issue.
It is a gigantic issue because not only do you have LIFO and FIFO and average cost, but you also have specific identification.
Yeah,
so we're getting into really complex tax strategies, which a good advisor can do with you, or a good accountant can do with you. But it requires a much deeper delve into your situation, the specificity of these, actually sitting down and doing a calculation, saying if we do this at this and this at this and this at this, what do we come up with? And running scenarios to try to determine which is best for you. I mean, you could find that first in, first out is better. You could find that last in, first out is usually last in, first out.
Is usually not.
They usually not, but
no.
It could be
I
different.
think most people use average
everybody.
Generally, they use average. Generally.
Yeah. Again, I don't want to state that, but I think it's probably pretty average. Yeah. It's easier. True. It's easy because your fund can give you the average, but this is where we move from being able to give you advice on the radio or in a podcast and you needing professional help.
It doesn't sound very professional with your dog barking behind you.
I don't know what she's barking about.
Thank you for your call.
And it's not supposed to be able to get. I got to get a solid core door. That's all there is to it.
And thank you for your call, Gates, and thank you for asking for help. By the way, those of you tuning in expecting to find the Doc Gallagher Radio Hour,
what are you talking
about? No longer heard at this time.
Oh, the Doc Gallagher show. Oh, my God.
No longer, because Doc is very busy. He's kind of tied up at this moment. Not going to be available for, let's just say 30 years or so. Doc and his gang, the Gallagher Financial, I shouldn't be laughing because this is really serious. He advertised on Christian radio, see you in church on Sunday. Now, he didn't apparently talk about what he was going to do on Monday when he was going to steal your money. Doc been doing that for a number of years. He got 25 years on another charge.
Wait.
Now he just got 30 years.
No, he got 3 life sentences.
I know they're calling it a 30-year sentence because they're concurrent, and he's 80. That's all. But he ended up taking 32
He's
million.
Not going to serve 30. He won't make it to 30 years.
I know. The point is, affinity fraud is alive and well, and you should always be cautious about that kind of thing.
Yeah, it was a Ponzi.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, you don't want an advisor just because they share your religious belief or they're nice people or they're neighbors. That's just not a good way to pick an advisor. You want a 100% fiduciary. You want someone who looks out for your best interests at all time. You want to make sure that you have your money with a third-party custodian, Schwab, TD Ameritrade, those kinds of places. And if you need a little help along the way, we have a fiduciary firm called Vestory. 100% fiduciary, 100% fee only, no commissions. We use Schwab to custody our money, but we'll help anybody, anytime, without obligation, without cost, and without a high-pressure sales pitch. You just go to Vestory.com and set up an appointment. That's Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.